Good afternoon. This is Sean Golding with Golding and Golding, here to provide a bit of an update to a previous article and presentation we did back in 2019 about 5 important facts you need to know about Form 3520. Form 3520 is one of those sneaky international reporting forms where oftentimes taxpayers do not have any tax implication because it's primarily used when a person receives a gift from a foreign person, but the IRS does like to penalize it. So let's go through the basics of 5 important things you need to know. First, who needs to file Form 3520? 3520 is filed by your typical cast of characters, your U.S. citizens, your lawful permanent residents, foreign nationals who meet the substantial presence test. We're talking just about individuals. Lawful permanent residents who live abroad in a treaty country may qualify to make a treaty election to be treated as a foreign person for tax purposes. If that is the case, then they may take the position that they're not required to file Form 3520. The IRS can disagree. Foreign nationals who meet the substantial presence test have to file, but if they qualify for an exception, such as the closer connection exception to a foreign country or foreign countries or another exception, then they don't file the 1040, they file the 1040 NR. They too may try to take the position that they're not required to file those pesky international reporting forms. Form 3520 is used to report foreign gifts. Foreign gifts includes foreign inheritances. It's also used to report when you own a foreign trust and if you are a U.S. person who gets a distribution from a foreign trust. So like you're a beneficiary of a foreign trust, maybe you're a discretionary beneficiary once in a while. Your sweet grandma allocates some of that money to you as a distribution. That's filed on Form 3520. The Form 3520 is due when your tax return is due. If you file an extension for Form 35 for your tax return, Form 3520 goes on extension as well. So let's go a few important things about 3520. But before we get into the 5 things you need to know, it should be 6 because there's one additional fact that people tend to get wrong, and it's a bit confusing. When someone gets a gift from a foreign person, and let's say that gift is $80,000, well, that's not reportable. But if it's related persons, then the related persons rule apply. And so if it's like 70,000 from one person and 50,000 from another person, that's 120,000. And even though you didn't get 100,000 from one individual, if they're related persons and the gifts in the same year, you'd have to file the Form 3520 anyway. And the purpose of that is to make sure people aren't gift splitting, right? Just to avoid having to report. So 5 things you need to know. One is the gift has to be more than $100,000. So, for example, you have a foreign relative, a foreign mom, and you're in the U.S. as a permanent resident. Let's say you just got off of OPT and maybe you just got married or whatnot, and your foreign parents want to give you a gift. There may not be a tax implication from receiving a cash gift, but you're still required to report it on Form 3520 if it exceeds the threshold. The threshold is if it's more than $100,000. That's if it comes from individuals. If the gift is from foreign entities, that one adjusts for inflation, and typically it's around 18,000 now, I believe. In addition, if you get a trust distribution, then that trust distribution is reportable even if the threshold isn't met, because there is no threshold. You don't have to meet either one of those 2 prior thresholds. So first 3 things you need to know. 1, if you get a gift from a foreign individual, it has to be more than 100,000, includes related parties. 2, if you get a gift from a foreign entity, it has to exceed the 18,000 give or take threshold. You should double check. There's a link within the instructions that'll take you to the updated inflationary amounts. 3, if you get a trust distribution, that trust distribution is reportable. Foreign trust, of course, is reportable even if it's de minimis. 4, you may get automatically assessed if you do not file it timely or you file it late and the IRS doesn't believe you have a reasonable cause or you qualify for streamlined or delinquency procedures. In other words, unlike other types of procedures that the IRS goes through when someone fails to report something, this type of penalty is an international information reporting penalty, and whether the IRS really has authority not to do it, oftentimes they will issue a notice, a CP-15 notice, without giving you any warning. You just go home one day, you're having a nice evening, you find this certified mail in your mailbox or whatnot, and you see and you open it and it says, CP-15, the penalty is 25% because it's 5% per month value of the gift and it's more than 5 months, so they go up to the maximum amount, 25%, and you get dinged with a penalty. Now, you can dispute that, and I'll get into it in a minute, but that's how they do it. Now, there was a recent case Farhi, you'll see that online a lot, where the IRS says, well, the tax court said that the IRS doesn't have the authority to issue international information reporting penalties. It should be noted that that case is specifically geared for Form 5471, and the IRS is disputing it. Their notice of appeal was filed by the government, but that 5471 Farhi ruling is only for 5471. Now, you can apply the concepts and the facts to 3520, but there is not a case, at least at the time of this, on point that says the IRS does not have the authority to ding people with Form 3520 automatically assessed penalties. There are ways to challenge the penalty, right? The best way to do it is try to avoid a penalty in the first place. So if you're filing it late, you file it with a reasonable cause submission. They're not always successful up front. Sometimes you have to do some back-end fighting as well. If you get a CP15, you might do a protest. You might have done the streamlined procedures. Oftentimes they waive the penalty. It's not guaranteed. Delinquency procedures, sometimes they waive the penalty, but it's not guaranteed. In fact, in November of 2020, the IRS updated the delinquency procedures so now that it's not automatic. So if all you had to do is file the FBAR, you may qualify for a delinquent FBAR and there's no penalty. If you have more than the FBAR, like the 8938 or the 3520, then the IRS no longer guarantees a penalty waiver. And of course, if there's an end game opportunity, you might be able to do a collection due process hearing, which can be successful because oftentimes you go to a settlement officer instead of an appeals officer, but there's a lot along that path, and CDP is normally your end game, and it doesn't always apply. We got a ton of free information on this stuff available on our website, our main website, and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.